Hi, guys. Thank you for joining us on this lovely Tuesday. I appreciate you taking your busy time or time out of your busy schedule to be with us. Uh, this is we're doing a four-part webinar series on educating investors on how to invest in real estate syndications. A little bit about me. My name is Joseph Feng. I'm the Director of Investor Relations with Break of Day Capital. We are a value-add multifamily operator focused in the Southwest, and we're currently concentrated in the high-growth markets of Arizona. A little bit about my background. My professional background is actually in investment management with over 10 years in the industry. And over time, since 2003, my wife and I have actually started investing in real estate. We started with a 9-unit multifamily, small multifamily in West Los Angeles. It was kind of fortuitous in that there was mandatory seller financing that came with the property, and I think it was a bit of a turnoff for most buyers. But for us, it actually worked out great because we probably could not have qualified for the bank loan in terms of net worth and liquidity at the time. And the property has been a great performer for us over the years. And then I would say that our next venture into successful real estate investing happened. We participated in the gentrification of the downtown Los Angeles, sort of the urban revitalization during that time, shortly after the Staples Center was built. I was working for a large fund manager and commuting in, like many other people, from one of the suburbs, and it was about an hour and a half commute going to work every day. And one day, off the side of the freeway, I saw a huge banner sign over a building that said that you can live here. So I was getting tired of the commute, so I thought about, well, that's actually not a bad idea. So I went to go look, and decided to purchase the property, having closer access, being able to walk to work from there. And as we started looking at the area, we discovered that we were in the path of progress, and that downtown Los Angeles was going through this gentrification process. I don't know how many of you guys remember, but if you're from there, downtown wasn't exactly a safe. It was kind of an unsavory place to be. People commuted in for work, but at night, everybody kind of scurried off and went back to their suburbs. It's kind of potentially dangerous at night. But we thought that being in the path of progress and having billions of dollars of investments, slated for construction, we thought that we could potentially participate in the appreciation. And sure enough, over the next 2-3 years, this is from 2003 to 2006, we saw significant appreciation in that market, and we certainly participated in that appreciation. Life was great. 2006. I mean, it was like all rainbows and unicorns. And if you guys remember that era, excuse me. The stock market was booming. We were getting paid big bonuses at work. Our rental properties were skyrocketing in value, and we treated ourselves to a really nice luxury home near the Hollywood Hills. Well, you also know that what must go up must come down. And so a couple of years later, as everything got bubblicious, Greenspan, the chairman of the Fed at the time, started to raise interest rates, and property values stopped going up. It started to plateau. And you guys remember all the people that took on loans that they couldn't really afford, started to default, and then basically hurt the banks as well. And so property values came tumbling down. It was like initially it started off like a train wreck in slow motion, but then it quickly got out of control. The contagion spread pretty quickly. And so by the time we got to 2009, we saw the other side of the bubble bursting, right? and eventually I also lost my job. And so, we had to do a significant amount of pivoting. We ended up leasing out our house to help with the mortgage payments. And then luckily, most of the properties that we bought in downtown Los Angeles, uh, uh, we had renters in place, and for the most part, we cash flowed. At least we're able to make all the payments, or in some instances, we actually have positive cash flow. And that apartment, the 9-unit apartment building that we had in West Los Angeles, certainly did okay during the great financial crisis. And so, coming out of that, there was it was definitely tough, learning, feeling the crunch, and just doing whatever you can to survive. And we certainly, survived it. And, out came a lot of lessons learned. And, but, as you guys might know, California is not exactly a landlord-friendly state. And so, as we continue to operate our real estate, we didn't want to take on more properties in California, and we were looking to go out of state, to diversify into other growth markets, and we explore the possible, and also having dealt with the headaches that come with being a landlord. There was certainly a lot of drama with tenants over the years. I'll be happy to share with you some of that later on in the presentation. We also wanted to do something more passive. And so we started networking and going to different meetups and learning about other ways to invest in real estate, maybe in a more passive manner. And so we looked into DSTs, which is a Delaware statutory trust. We looked into turnkey single-family rentals out of state, and also just got to learn about just regular syndications. And ultimately, that was the route that we chose. And so since 2017, my wife and I have been investing in real estate passively through a variety of commercial real estate syndications. I mean, we've invested in all types of asset types, ranging from distressed debt to hard money loans to multifamily, retail, self-storage, mobile home parks, even ventured into crypto and artificial intelligence and other types of venture capital investing. And so, but we always kind of favor multifamily. It's something that we know very well, and so the bulk of our portfolio is in multifamily. And there's just something really cool about taking an older property and giving it a new life. It just kind of sort of making the property and the neighborhood nicer. So since 2017, my wife and I have invested in over 50 plus syndications, and it's done really well and really supercharge our investment portfolio. And we got to enjoy the benefits of the passive income. And so my wife and I sort of retreated to the rural countryside, kind of living this modest, quiet life, where we got to enjoy got to explore other interests in life, particularly health. We got to work on our health, improving on our health, healthy living lifestyle, so to speak. When you get your money right, you kind of want to get your body and mind right as well, right? So health and wealth kind of go hand in hand. That's one of my other passions in life. But truth be told, life got a little bit too slow. And when the opportunity came to join Break of Day Capital, to join Gary, and his team, somebody that he's a good friend that I've known for several years and have been investing successfully, with Break of Day Capital. When an opportunity came up for me to join the team, I gladly jumped at the chance. This was my, opportunity to, get back into the active side of the business, and then really, just something that was missing in my life. I feel like to fulfill my purpose of sharing my investment experience, not only as a landlord, but also investing in other people's deals, just being able to share that experience, that journey, the good and the bad and ugly, even to help as many people as long as possible, and hopefully be able to add value as you go on your journey of creating wealth and preserving wealth and ultimately achieving time and financial freedom. So today we're gonna kind of get into the basics of real estate syndications. So what is a syndication? And before we do that, let's talk about real estate. Like, why do we even bother with real estate in the first place, right? Well, real estate investing is ideal, okay? And before we get into that, let me just clarify. If you read Robert Kiyosaki's Rich Dad Poor Dad, we're not talking about your primary residence, right? We're talking about your rental property, an income producing property. So real estate investing, and we're specifically talking about income producing property, is ideal because you get a stream of income. I mean, that's kind of one of the major points about rental real estate is that it produces income. You collect rent every month, and you have the cash flow. It's also great. The government, the IRS, really incentivizes people to provide housing. It's one of the great needs of society, and so you get favorable tax treatments, right? So you have this asset that is appreciating, but yet you get to depreciate. What it is a depreciation is it's a non-cash expense. So you're not really paying this out of pocket, right? But it's just an accounting entry that reduces your taxable income, right? And later on, if you want, we can get into some of the technical details. There's different ways of accelerating that depreciation where you can front load a lot of that depreciation, in the beginning in the first year, which can then be used to offset your other taxable gains. You build equity over time, right? So as you pay down your mortgage, actually more correctly, your tenants are actually paying down your mortgage, right? And so as you pay down your mortgage, you increase your equity regardless of what the market's doing. So you're kind of building equity in that sense. And real estate, hard assets, like real estate, they tend to appreciate over time, not only due to growth. You have population growth, you have job growth, you have just things, when you're in the path of progress, right? There's going to be more people that need housing, and so the property value, because of demand and supply doesn't necessarily increase in a dramatic way, real estate prices tend to go up over time. Furthermore, over the past 40 years, the Fed has been kind of, inflating or sort of printing our money supply whenever there's any kind of trouble, or if we just wanting to kind of stimulate the economy out of a recessionary condition. So over time, the Fed, prints, they increase the supply of our money, and what that does is it pushes up the asset prices of hard assets, and real estate being one of the primary beneficiaries. Okay, so that's where the appreciation comes in. And finally, you have leverage, right? Sure, there's people that buy real estate with cash, but for the most part, you can put on sensible debt, and what that does is it can magnify your returns with just a small increase in your equity cap, small increase of risk to your equity capital, right? Now, of course, you can overdo this on the, leverage can kill, or it can actually work against you if you overdo it, right? I mean, you probably hear about some of that happening today with some of the real estate operators putting on, bridge debt, floating, or maybe using too much, leverage, 80-85%, loan to value, and they can't handle the, as interest rates go up, and if they don't have insurance on that interest rate, they don't have an interest rate cap on that interest rate going up, the debt servicing costs can really be problematic, which is what's happening to some of the operators today. Okay, well, now that I convinced you that real estate in general is a pretty good asset, to to invest in. There's certainly lots of pros, but like with everything, there are also cons, right? And so what are the challenges of owning real estate? Well, so owning and operating real estate is not passive at all, right? It's at the very least kind of a part-time job, or it could be, and then if you have a lot of properties, it can quickly become a full-time job. Speaking from somebody who has that experience, not only directly owning real estate and operating it over many years and going through the bubble and then surviving through the crash, dealing with tenants, regulatory issues. I've been sued a few times, so I know what it's like. There's certainly a lot of brain damage and drama that comes with owning real estate. Just a side note there, you've probably have heard of turnkey rentals, where you can buy these cash flowing single family residential properties out of state. You can buy them with cash and make a little bit of cash flow, or if you put on debt, you might only have a little bit of cash flow. There's a property management company that'll run everything for you, but again, that's something like that isn't really truly passive, right? You still have to qualify for the loan. You still have to manage the manager, and if you have turnover, you're still going to have to spend several $1,000s to make the unit, or make the property, you have to make ready for the next tenant, right? So you have to put in more money to fix it up. And then and what they don't tell you is that, if you have a roof leak, or if you have an AC that goes out, that's several $1,000s out of pocket, right? So it's really not, a turnkey property is really not passive either, right? And perhaps one of the biggest problems of being a landlord is that there is liability, right? There's a potential for liability. You can have injuries that occur on the property. You can have fires, and it can potentially be really serious, right? Now, you are required to have liability insurance, but there's always the risk that, the incident could potentially exceed your coverage, or you find out that, you come to find out that, maybe whatever the incident is not covered by your insurance or your insurance coverage, which is really problematic. So over the years, being a landlord, I can certainly, I want to kind of share with you some of the drama that we've personally faced. We had one scenario where a couple of our tenants called to complain that one of their neighbors is believed to be a call girl, and that she was having strange men coming into her unit at different times of the week, and they like want me to do something about it. And I'm just like, well, first of all, I don't want to hear about this, but it's like, how do I even accuse, how do I go up to the tenant that's allegedly doing this? And it's like, I don't have any evidence of this. And it's kind of like, well, so I kind of turned it around on the other tenants, saying, hey, why don't you guys take pictures and take videos, and then see if you can catch it in the act, and maybe we can do something about it. There was certainly a lot of drama there. And then another time, we had this lady, she was walking on the sidewalk, and she slipped and fell and twisted her ankle, right? So we got sued for that. But what was kind of wonky about it is that, the sidewalk, and then where the trees on the sidewalk that was kind of pushing up on the sidewalk where she kind of tripped. The sidewalk actually belonged to the city, but yet the landlord was partially responsible for the maintenance of the sidewalk. So, and then we couldn't just do whatever we wanted with the sidewalk or to the tree. Like, you had to get the city's permission, and they usually don't want you to touch anything, which is kind of, contradiction. But anyway, this lady, she tripped and twisted her ankle, and then so she had her lawyer basically sue the city and us, and luckily we the the medical claim wasn't too bad, and we were able to do a quick settlement. But just again, the drama that comes with that, the just worrying about what how this was going to get resolved, right? And then we had and this was a bit of a unfortunate situation, but there was another time where this pre-med student that we had at the 9-unit apartment building, he actually found out that he didn't matriculate into medical school and ended up committing suicide on the property. And so that was a pretty traumatic experience, having to deal with that whole situation. So that was pretty tough. And then just a couple more before we move on. But we had this other tenant who's a photographer, and we had rented out to him one of our lofts in downtown LA. And this is in the arts district where there's a lot of filming that goes on in the neighborhood. And he was, he does a lot of photo shoots in the unit. And then sometimes he would have like an assistant follow him around with a portable camera, kind of, sort of like a behind the scenes of what the photo shoot, right? And so I don't know what it was, but there was an HOA board member who just had it out for my tenant. And he, without the permission, and was doing this on his own, without the permission of the HOA, he had hired a private investigator to follow my tenant around, kind of documenting on whatever violations that he supposedly had, and basically engage in a law firm to sue my tenant and myself for violating HOA rules, specifically, not filming, on the premise. But it wasn't really like, but the thing that you should know is that the no filming clause in our HOA was they're really talking about like the proper movie set, like on, for like a commercial, a proper commercial, or like a, like a movie set, right? Not like somebody, doing behind the scenes for their own photo shoot, right? It wasn't a big production. So anyway, we couldn't get fined for this particular violation, alleged violation. And so what he did was he hired this law firm to sue us. And then basically we end up having to settle with the law firm to cover their costs. Ultimately, we just, there wasn't really any, the settlement was just to stop whatever he was doing. And the HOA basically dropped the charges, but we still had to compensate the HOA, for the law firm. And so, just again, that was another really stressful situation. And finally, the straw that broke the camel's back was if you are a landlord in California, Los Angeles, you are probably aware of what professional tenants are, right? And these are people that come in, they're really nice to you, they pay for a couple of months, and then they stop paying, month 3. And when you ask why, they will say, oh, because the plumbing doesn't work, or because the paint's peeling, or something's wrong, right? And then so you send your guys over there, you send your maintenance crew over there, and you find out it was them that that stuck something in the drain, or they purposely kept the shower on for hours so that it would steam up and cause the paint to cause damage to the paint. And it was like whatever excuse to not have to pay. Meanwhile, they get to enjoy using the place for sometimes many months. And so as you might know, California being a very landlord unfriendly state, then it takes, when you have issues with tenants that don't want to pay, it's very difficult to get them out. And so we had to engage an eviction attorney, and the tenants, there's actually various legal firms that represent tenants, and they don't have to pay until there's a settlement, right? And so it's all on a contingency basis, so tenants can easily get legal representation. And 9 out of 10 times we still have to end up paying them to settle, and for them to basically pack up and leave. And so just the stress, the cost involved in removing a problematic professional tenant, we were just fed up, and that's why we started investing passively in syndications. And finally, real estate investing is it's a high, it's a high ticket price item, right? And if you're investing in California, I mean, it's very difficult to find properties that are less than million dollars. And, and you will find out, as you scale, as you add more properties, you too quickly, run out of capital. And, if you're trying to get agency debt, there's a limit to how many you can get before you have to go into other alternative lending products like the non-QM loans, the DSCR stuff, the portfolio loans that carry higher interest, right? I mean, even guys like us, like multifamily operators in the kind of in that 150 plus unit space where we're buying stuff in the 25, 30, 40 million dollar range. I mean, we're always need to partner with with investors, because like the slide says, the real estate investing is capital intensive. Okay, well, so with that in mind, so now that you understand the pros and cons of owning and managing real estate, well, there is a way to kind of do this in a less painful way, so to speak, with less brain damage. Well, there is something there. There's something called a syndication, right? You might have heard this before. It sounds like some secret, sinister underground organization in a James Bond movie, but really it's syndication is just, it really just means group investing. And basically a group of people come together, they contribute capital for the purpose of buying an asset. Okay, that's all that means. And what is really cool about syndication is that it is an ideal collaboration between the active investor and the passive investor, right? So the active investor, generally referred to as the GP or general partner, sponsor or operator, they're passionate about owning and operating real estate, and so they're the ones responsible for leading, the investment, everything from acquisition to operating the property, asset managing, operating. Managing the manager, seeing through the business plan, making sure that the value add strategy is executed properly, and then take it all the way to disposition and ultimately delivering a strong return, to the limited partners or to the passive investors. And speaking of limited partners, the passive investors, this is also a great way for people, busy professionals, who don't necessarily want to be hands-on in real estate, but likes the benefits that come with real estate investing. The things that we talked about earlier. Mainly the cash flow, the equity growth, the tax benefits, and that the diversification from the stock market. And so this is really when it's done properly, it's a really good marriage between those that want to be active and those that want to be passive. Okay. And another way to think about it is it's a perfect bridge between directly owning real estate versus just investing in publicly traded real estate investment trusts. It's really, being in a real estate syndication really gives you the best of both worlds. Okay. So here, we're going to talk a little bit about multifamily syndication. Now, there's different types of syndications. I mean, you can have, as I alluded to earlier, there's self-storage, there's mobile home parks, there's office, there's industrial, there's retail. But since Breakup Day Capital, our niche focus is in value-add multifamily, we'll stick to the multifamily. So there's a lot of benefits investing in multifamily syndication, right? So one of the most important is that it is a truly passive investment, right? So the LP's job, really, your work is just to do the due diligence up front, on the sponsor and on the deal, making sure that you're working with somebody that that you can trust and that you like, right? And so, and then you also want to evaluate the deal to see if it's appropriate for your portfolio, right? And being that a syndication structure is typically set up as a pass-through entity, so it's a typical LLC, and so all the cash flow, the equity appreciation, the tax benefits, it all flows through to the excuse me, to the passive investor, right? As if you directly own the real estate, and so in that sense, you and then you can do that in a passive manner, right? All the benefits, but in a passive way. So that's one of the biggest benefits, right? And then because you're pulling capital together, buying larger institutional grade properties, you actually get to enjoy the benefits of having that economies of scale, right? So if you think about when you're buying these 150 plus units, right? It's like, and if you're doing value add strategy where you're actually making improvements to the property, and then you bring rents up, closer to market, imagine it's like, you probably know people that do fix and flips, right? You buy an older property, you fix it up, and then you get paid for the improvements that you make, right? Well, imagine doing that 150 times, right? So you can kind of see how like you can multiply that value add or the additional value that you create 100 times, 150 times in the same location, right? And also when you're at that level, because the property cash flows so well, you can actually afford to have a full-time staff on site. You can you have an office, you have a full-time maintenance crew, and so that cost is actually a lot lower than if you were to, let's say if you were investing in a couple rental properties where you're paying 10 to 12% for property management fee, whereas like we're paying like 2.5%, 3.5% management fee. So you could see the huge difference in the cost savings there. And also if you're having to hire out vendors, it's you're having to pay the retail price, having like an external vendor come in, whereas like having a professional staff, having a professional maintenance crew, you're basically paying them a fixed salary, right? And then there's enough work to do that. They're basically busy all day long, and so it's a lot cheaper than having to pay retail. Okay, and another benefit is leverage, and we're not talking about the leverage on the loan, but we're talking about leveraging the operator's relationship that they have built over the years with brokers, with lenders, with a variety of vendors, construction management companies, to be able to get to acquire favorable favorable properties to invest in, right? These the way that multifamily, this large commercial multifamily industry works is that it's a bit of a, I hate to say this, but it's a bit of a like an old boys network. It's all about relationships, and you could walk into town with $50 million, and if nobody knows you, they're not going to want to sell you one of these deals. They have to look good in front of the sellers, and you have to have a track record of successfully closing on these deals. And so when you're investing with an operator, you're leveraging that relationship that it took them years to build. Okay. And here's probably one of the biggest benefits, and speaking as somebody who's and then that's why I kind of went on and on about all the drama and the brain damage that can come with being an active landlord, being a landlord, is because there's certainly a lot of drama and liability that can come with being a landlord, but as an LP in a syndication, you have limited liability since you're not directly involved in the day-to-day management. You typically have limited liabilities, and so usually that's limited to the amount that you invest. Okay, so worst case scenario, you lose your capital, but they're not going to be able to come after you for additional damages beyond what you invested. Okay. And then a couple more benefits. Diversification is another good one. And here, and so I want to clarify something. when you directly own and operate real estate, I don't consider that as a diversification from the traditional stock bond portfolio because it is hands-on. It requires time, right, and effort. And so it's not really passive, right? And so you can't really compare that to owning a stock portfolio, right? However, investing in a syndication is passive, and so that is more, that would be more of a true diversification within a stock bond portfolio. And something that you probably already know, real estate, is non-correlated. Now it does have its own business cycle, but it is generally non-correlated to the overall stock market, and it tends to be less volatile, than publicly traded securities. And so, and it tends to carry a higher, expected return as well. So, a typical stock portfolio, or I should say, let's say the S&P 500 index tends to produce an 8% annualized return over a long period of time, right? Whereas the syndications, you could get anywhere between 12, to 20% IRR depending on the investment strategy. So that significantly outperforms the stock market with less volatility, right? And so that tends to enhance your overall total portfolio return. Okay. And finally, there's a concept called forced appreciation that you may have heard of. And this is the idea. And this is why we love the value add strategy, which is that, you buy an older property, that's a little bit, outdated or has a lot of different maintenance, or it's been neglected, over time, many landlords become tired, like us, and they kind of let the properties go a little bit. And, so you can actually come in and, make improvements and increase the property value, right? And so because these larger multifamily properties, they're valued based on the stream of income, right? And so to the extent that you can improve on the operations and increase the net operating income, you can actually force that appreciation regardless of what the market's doing. This is very different from the single family residential where, the property value is really based on what recent comparables, as I say, whatever comparable real estate, I should say property, sold for is kind of, what yours will kind of sell at, right? But whereas like in these types of commercial multifamily properties, because it's really a rental business, it's value based on, a stream of income, right? So you can literally have two properties are identical on the same block. If one of them makes more money, it's actually worth more money. Okay. Something else that I want to mention to you, some of our colleagues, competitors have pivoted, in recent years, to car washes, to RV parks, to, even self-storage, right? And it's because, the multifamily space have become crowded, right? You have heard people talking about the cap rates compressing, and it's because there's a lot of money chasing after these deals. Why? Because they're very desirable, right? And so, something that we really like is that there is this structural shortage of affordable housing. In fact, there's a group called the National Multifamily Housing Council, and these are the guys that are one of the biggest groups that deals with apartments. And their economists estimate that there's a shortage of something around 4.3 million units that are needed through 2035, and that we are currently somewhere around 600,000 units short today as a result of undersupply coming out of the great financial crisis in 2008. Okay, and so what happens is that you have this mega trend, that you have this shortage of affordable housing, and specifically, where we focus is the value add multifamily aspect of affordable housing. You have this really long runway, and and as you guys might know, with the recent higher inflationary environment, with higher labor cost, with higher material cost, developers are not building more of these workforce housing, affordable housing. They're building the Class A luxury stuff, and so then that's a whole different price point from where where we are, which is this Class B and C workforce housing. And another thing that you don't hear a lot about is that properties, Class A properties, over time they will become outdated. They turn into Class B, they turn into Class C if they're really outdated, right? And so every few years, there's a group of properties that become dilapidated or undermanaged, and they become undervalued. So you can go in there, fix them up, add in modern amenities, and bring the rents closer to market, and basically drive that value, that forced appreciation that we talked about earlier. So this is a strategy that we can continue to it's a sustainable investment strategy, and this is why we focus on this one niche, and we're not interested in pivoting and doing something differently, as some of our operator or some of our colleagues have done. Okay, just like with everything, not everything has its pros and cons. There's really nothing that is truly risk-free. Not even cash in the bank today, right? Maybe that's a bad joke right now, but yeah, I mean, who would have thought that cash in the bank today is also not without risks, okay? But just something to be aware of. I mentioned to you all the benefits of real estate investing and how to do it painlessly, through a syndication. But please be aware, that aware of the risk involved, right? Real estate, whether it's directly owned or through a syndication, it is illiquid, okay? You should expect to hold these for a number of years, typical holds between 3 to 5 years, and it could take a lot longer, if we're going through another major downturn, just something that you need to be prepared of. Now, there are times that if for some reason, you really need to get your money back, you have some unforeseen family emergency, have a conversation with the operator. There is a chance that they may be able to accommodate, giving you liquidity or maybe at least to put you in touch with other investors that might be willing to buy out your position. So there is a way to get out, if it's absolutely necessary. But going in, just expect that you're gonna, it's gonna be a long-term hold, okay? And then and keep in mind that because you are entrusting the sponsor team, to basically manage the entire investment life cycle, you have to, once you put your money in, that's it, you're along for the ride. So you got to be comfortable giving up control, okay? So one thing that you need to remember is that you need to do your homework. You need to do your due diligence on the sponsor up front, okay? I want to add that next week, we're going to be doing the second part of our 4-part series. We're going to be discussing how to evaluate sponsor, the kind of questions that you can ask, and then decide for yourself whether that's somebody that you're comfortable with, okay? So that's you got to do your homework upfront, okay? And then now also understand the risks and involved in executing the business strategy here, which is that when the operator present to you their underwriting, you'll see a pro forma, which is just a guess of what the property is likely to do, over time. And now keep in mind that your renters, have a life of their own, right? They could care less about your underwriting. Oh, and that, you're trying to hit a 5% cash on cash, distribution in year two, right? They they have their own life, and again, that's why I went and explained to you all the different situations that we've had to deal with, like all the drama that comes with managing tenants. You have to understand that when you're executing the business plan, it's just a matter of how much you will go off track, right? There are times where the department's going to do a lot better than what your spreadsheet says, and there are going to be times that it's underperforming, but that's all should be expected. So don't freak out. If you see, as you invest in these kind of deals, you'll see some months that are great, some months that are less good, and so just as long, you just want to make sure that the operator are good at what they do, and then they know how to operate through, successfully navigating through obstacles is really what you want to be able to count them on. It's, things are going to go wrong, and if you talk to an operator and they tell you that nothing ever goes wrong, or they've never experienced any obstacles, that is either they haven't been doing this long enough, or that's just simply not true. Okay. But finally, I just want to finish by saying that, look, investing in syndications, there isn't really, like, it's not like these risks are unique to syndications. They are very similar to as if you're owning real estate directly. Okay.